Hello and welcome to Structured Finance in Focus, a Fitch Ratings podcast that delves into the latest developments across global ABS, CMBS, CLOs, and more. I'm Haider Sarwar, a Senior Director in the EMEA RMBS team, and today we will be discussing the current situation in the legacy UK non-conforming mortgage market sector with my colleague Brad Kellman, who's an Associate Director in the EMEA RMBS team. So, Brad, thanks for joining me today. Could you outline what we have been observing in the sector over the last couple of years? There seems as though there has been a lot of activity.
Thanks, Haider. So some context first. The UK non-conforming sector are loans originated during the run-up to the GFC and are now highly seasoned. They are mainly interest-only floating rate loans which have rolled off their initial fixed rates more than a decade ago. The key thing is that these loans were made to riskier borrowers at a time when underwriting standards were much more relaxed. So we typically see substantial amounts of self-certified income as well as adverse credit features like CCJs and prior bankruptcies or individual voluntary arrangements. We have been seeing quite a bit of stress in the UK non-conforming sector since the Bank of England tightened monetary policy over the last 24 months. These interest rate increases represent a significant affordability shock for these borrowers. This stress has mainly manifested in rising arrears levels as borrowers struggle to keep up with higher payments. To give some numbers, as at November 2024, Fitch's UKN RMBS index showed 1 month plus arrears levels of 24.2% and 3 month plus arrears levels of 17.7%. This represented 11.1 and 8.6 percentage point increases in 1 month plus and 3 month plus arrears, respectively, since December 2021. Notably, this means late-stage arrears have now surpassed their GFC peak. In terms of prepayments now, for many of the legacy RMBS transactions which we rate, the arrears position has also been exacerbated a bit by prepayment activity. So as rates began to rise, we observed a noticeable spike in our Fitch non-conforming CPR index. It seems that many of the stronger non-conforming borrowers chose that time as rates began rising to repay their mortgage rather than stick around and pay materially higher rates. So this had resulted in some pools becoming quite concentrated to riskier non-conforming borrowers in our view.
Thanks, Brad. So it seems as though performance has deteriorated quite a lot. What have services been doing? Has there been an increase in possession activity at all?
This is quite interesting. So despite this big accumulation in arrears, repossession activity has been very muted. Fitch's non-conforming constant default rate index remained low, averaging just 0.7% over the 12-month period ending November 2024, despite 3 month plus arrears reaching 17.7%. This is in line with the wider UK mortgage market, where servicers have sought to be flexible and work with borrowers facing challenges. Additionally, while many of the servicers in non-conforming pools did not sign up to the mortgage charter enacted in June 2023, they have adopted similar principles in seeking to support borrowers during this period. In the limited repossession activity there has been, loss severity has been high, in our opinion, which is a bit surprising. Fitch has observed loss severity in the range of 10 to 30% on most non-conforming collateral pools. Notably, this is across a very small sample set and likely to be related to the most negative arrears and possession cases, so we do need to be cautious when interpreting this observed loss severity. However, it is a bit concerning for us as these are highly seasoned loans where properties should have benefited from substantial house price depreciation over the last 15 years. So on an indexed CLTV basis, these loans present as very low risk and should provide strong recoveries in the event of default. We think this worse than expected loss severity could be the result of a few factors, namely significant arrears accumulation leading to negative equity positions, as some borrowers may have incurred substantial arrears over multiple years. Also, there's dilapidation risk. These are weak borrowers who have historically struggled to keep up with their mortgage payments, so it is unlikely that these borrowers have regularly undertaken maintenance and updates of their homes. Additionally, there's the general limitations of house price appreciation as an approximation of value. Some properties could be located in less desirable, more economically depressed areas of the UK, so housing demand could be muted in these areas, affecting prices.
Okay, that's interesting. Now, we know these loans are mainly interest-only loans, and they should be approaching their maturity dates in the coming years. And given the performance deterioration that you've already spoken about, what are our expectations when these loans reach those maturity dates?
Great question. So it seems like a growing number of these interest-only, non-conforming loans are reaching maturity and not repaying the outstanding principal balance. The FCA has done some work on this, and they estimate that approximately 750,000 interest-only mortgages are set to mature over the next 8 years. Approximately 55% of this outstanding stock was originated prior to 2009, making them likely to have borrower characteristics similar to the standard non-conforming mortgage. From the outstanding stock of interest-only loans, approximately 2.5% have already exceeded their original maturity. We expect this percentage to increase in the coming years as more loans reach their maturity. There are two major maturity windows approaching, 2025 to 2027, and then 2030 to 2032. During this time, approximately 337,000 loans are expected to mature. The majority of the non-conforming borrowers didn't have a repayment vehicle in place at the time of loan origination, and it is unknown whether these borrowers have established a repayment strategy during the life of the loan. Given the volume of maturity scheduled in the coming years, we definitely think this position will deteriorate further. Additionally, when we consider factors like borrower vulnerability, this can make it difficult for servicers to manage.
Okay, that's a really good point you mentioned there regarding vulnerability. Could you tell us a bit more about how this will feature in the sector?
Yep, sure. So this is another emerging trend in the non-conforming space and can be a contributing factor to some of the arrears accumulation we've seen. The FCA defines borrower vulnerability as those individuals who are susceptible to harm when a firm doesn't act with appropriate levels of care, which is quite a broad definition, but there are four categories of vulnerability outlined by the FCA, namely health, life events, resilience, and capability. These categories cover a wide array of life scenarios, including death of a spouse, domestic abuse, income shocks, and even substance addiction. When vulnerability leads to a borrower falling into arrears, this can create significant challenges for a servicer in terms of resolving the position. Servicers have typically had to be much more accommodative with vulnerable borrowers, in some instances leading to substantial forbearance over extended periods of time. The proportion of vulnerable borrowers present in non-conforming pools rated by Fitch varies widely. This is potentially due to each servicer's unique interpretation of the FCA guidance and the characteristics of borrowers in various pools. Overall, though, we expect the proportion of identified vulnerable borrowers in non-conforming pools to increase over time as borrowers age and performing borrowers redeem.
Thanks for that, Brad. Super interesting point there. I mean, if we look at the bigger picture, there are quite a few unknowns. There are negative trends in the sector at the moment. What are our expectations for the future? Do we think any of these risks will subside?
Yeah, so you're right there. Quite a bit happening in the sector at the moment. Unfortunately, a lot of it is negative. So we believe that the non-conforming sector is now entering an acutely risky phase in its life cycle. The majority of stronger borrowers have now exited the sector, and interest rates are unlikely to return to post-GFC historic lows. The outstanding stock of non-conforming loans represent a concentration of adverse credit characteristics with elevated proportions of total and late-stage arrears and material proportions of borrowers who have made no significant payment in recent months. We also have these two significant maturity windows approaching, and servicers will need to have effective strategies in place to cope with borrowers who may be vulnerable and unable to meet their principal payment. There could be alternative products which some of these borrowers could go to, like retirement interest only or equity release mortgages. However, the viability of these options is uncertain. In a worst case scenario, we think maybe a regulatory agency or the government may need to intervene and support these types of borrowers to find some kind of amicable solution to repay the principal balance. So yes, difficult to say with lots of moving parts at the moment, but overall, the wider picture is not looking great for the sector.
Thank you, Brad. So I think that will bring us to the end of our discussion. It's been very, very insightful. And if you would like to find out more about Fitch's special report covering the UK non-conforming mortgage market, you can visit us and check out the report on fitchratings.com. Thank you very much.